Brent crude just delivered the classic melt-up trap. On Monday, missiles were in the air, headlines screamed, and the price surged over 5%. You probably saw the alerts, crude exploding higher. And then, in the space of a few hours, it all vanished. The market settled just $1.16 higher, at $94.25. Right now, Brent is trading at $94.10, and the daily chart is printing a strong sell. That 5% spike was not a breakout. It was a liquidity grab. It was a giant bull trap designed to suck in late longs before the rug pull. There is one danger zone and one hidden opportunity right now, and I am going to show you both. Stay to the end, because I am giving you 3 exact levels you can trade tomorrow, and one invalidation number that changes the entire structure. If you are long crude right now hoping for a supply shock, you need to see what the demand side is screaming. Let's call the session bias immediately. Brent is in a fading, rally selling mode within a powerful daily bearish structure. The intraday trends on the 5-hour and 1-hour are both strong sell. The market is trapped between resistance at 96.13 and support at 93.87, but the gravitational pull is lower, much lower. The single level that flips the bias is 97.26. Write that number down, 97.26. If Brent closes on the daily above 97.26, the entire bearish thesis is dead. And we shift to a neutral to bullish posture. Below it, every single bounce is a short opportunity. Now, here is the micro insight you will not find on the fast money channels. The herd is positioned net long crude oil futures. They are betting that Iran and Israel will re-escalate any minute, that the ceasefire won't hold. But look at the price. It can't even hold above $95. When a market fails to rally on seemingly bullish news, it is a screaming sell signal. That is the textbook trap long scenario. They are all waiting for the next missile, and while they wait, the floor is rotting beneath them. You do not want to be in that crowd. Now, walk the charts with me from the monthly all the way down to the 60-minute, because the alignment is rare and dangerous. The monthly trend is still a strong buy. That tells you the structural bull market from the early days of the Iran conflict is technically intact. The 200-day moving average sits way down at 83.84, so on a long-term basis we are still in an uptrend. But zoom into the weekly. Momentum has stalled to neutral. The weekly candle is indecisive, long upper wick, small real body. The big time frames are now in a tug-of-war. Now drop to the daily, and that is where the damage is. The daily trend is a strong sell. Price is trading below the 5-day moving average of 94.50, below the 10-day moving average at 95.94, and far below the 20-day moving average at 97.66. That 20-day MA is sloping down hard, acting like a descending brick wall. The 50-day MA at 97.35 is also overhead. This is a textbook bearish alignment, short-term moving averages stacked bearish, and price trapped beneath them. The daily MACD is at negative 2.18, the signal line firmly below zero, and the histogram has been declining for 4 consecutive days. There is no bullish crossover anywhere on the visible horizon. The RSI sits at 43.53, not yet oversold, meaning there is still plenty of room to fall before buyers even think about stepping in with conviction. The bull-bear power indicator is minus 0.964. Sellers are in absolute control. Now, let's move to the 4-hour chart, because this is where most traders will miss the hidden signal. The 4-hour trend is strong sell, but here is the twist. Look at the MACD histogram. While price carved out a slightly lower low near 93.87 earlier this week, the histogram printed a higher low. That is a hidden bullish divergence. Momentum on the downside is actually weakening. It is not a buy signal yet, please hear me clearly. It is a warning that the selling pressure is exhausting. The 1-hour chart, however, remains a strong sell, perfectly aligned with the daily. So we must respect the primary trend, but this hidden divergence is exactly the kind of trapdoor that destroys late shorts if support holds. Keep that in the back of your mind. Support and resistance levels are crystal clear. Immediate support is 94.55, the floor from late last week. A break below that opens the trapdoor straight to 93.87, the multi-session swing low and the line in the sand. Below that, the 100-day moving average at 92.10 is the next structural support, a level that has held the entire uptrend since the conflict started. On the upside, resistance starts at the psychological $95 mark, a big round number that was support last week and is now resistance. Next, the Monday spike high at 96.13, then 96.81, and finally the invalidation level at 97.26. Weave in the crosser-set linkage now, because oil is the geopolitical heartbeat, and it is not trading in a vacuum. Right now, Brent is moving almost tick-for-tick inversely to the S&P 500. When equity futures rally on peace headlines, crude immediately sells off as the fear bid evaporates. The US 10-year yield dipped on Monday, signaling a safe haven flow, yet oil couldn't hold its war premium. That is a critical divergence. Meanwhile, the dollar is stable, so the commodity channel is being driven purely by supply-demand repricing, not FX noise. This matters enormously. And there is another force at play that nobody on television is connecting. The demand side is collapsing while everyone stares at the Middle East. Let's go there. The 24-hour news flow was a masterclass in fading the event. Iran and Israel said they halted attacks after President Trump's appeal. The algorithms read ceasefire and immediately priced out the worst-case supply disruption, but then Tehran warned it would resume strikes if Israel keeps hitting Hezbollah in Lebanon. So we have a fragile pause, not a lasting peace. The initial spike above $97 was pure panic. The fact that it settled only a buck higher tells you the smart money sold into that euphoria with both hands. And then, buried in the data, Eurostat released a bombshell. Eurozone automotive fuel sales slumped 3.5% year-on-year in April, the steepest decline since October 2023. This is direct evidence of demand destruction. High pump prices, which soared when Brent briefly touched 126 in April, have crushed European consumption. Month-on-month, fuel sales also slipped, suggesting drivers filled up at the start of the conflict and then conserved aggressively. At the same time, EV sales in Europe surged 34%. The structural shift away from gasoline and diesel is accelerating right when oil needs demand to support the war premium. This is the narrative gap. The market is busy pricing a supply disruption that hasn't happened, while a verified demand contraction is already unfolding. When you combine a fragile ceasefire with crumbling fuel demand, you get a price that will struggle to hold any geopolitical bid. My 1 to 2 week directional lean is bearish. I expect Brent to test 93.87, and if EIA inventory data tomorrow prints a build and the ceasefire holds, a move toward 92.10 is very much on the table. The exact event that invalidates this bearish thesis is a sudden escalation that materially takes barrels offline, a strike on a major production facility, or a daily close above 97.26. Do you think Brent will break below $93 this week? Comment yes or no right now. I am tracking trader consensus, and the split is almost 50-50, which tells me a large directional move is imminent. Now, this is the section most people skip, and that is exactly where the money is made. Keep watching. I am handing you 3 trade strategies with precise triggers, stops, and targets. No theory, only actionable numbers designed for this exact market structure, the sniper. The conservative, high probability short on a rally into resistance. The idea is simple. Wait for price to retrace to the $95 zone, a psychological level that was support last week and has now flipped to resistance. The entry trigger is a 1-hour candle close above $95, followed by a clear rejection, a bearish engulfing pattern or a long upper wick that traps late buyers. You could also set a sell limit order at $95 exactly. The stop loss goes at $95.70. Why $95.70? Because that sits just above the lower end of Monday's failed spike zone and above the 5-day moving average. A move through that level would signal the intraday trend is shifting, and we want no part of it. Take profit 1 is 93.87, the major swing low. That gives you a risk reward of 1 to 2.2. Take profit 2 is 92.10, the 100-day moving average, stretching the reward to 1 to 4.9. This setup is void if Brent stages a daily close above 96.13. That would be a higher high, breaking the bearish structure, and you exit immediately. The sniper, conservative, entry, 95.00, limit or 1H close rejection, stop loss, 95.70, take profit 1, 93.87, take profit 2, 92.10, risk, reward, 1 minute and 2.2 seconds, 1 minute and 4.9 seconds, invalidation, daily close above 96.13, now, the active trader. This is for those who want to ride a breakdown momentum leg. The setup waits for a 1-hour candle to close below the critical 93.87 support. That triggers a sell stop entry at 93.80, giving you a 7-pip cushion to avoid the fake-out wick. Stop loss goes at 94.30, above the minor consolidation that forms during the preceding hours and above what was the 94.55 support turned resistance. Take profit 1 is $93 even, a round number and previous minor support, yielding a 1 to 1.6 risk reward. Take profit 2 is 92.10 again, the major structural demand zone, turning the trade into a 1 to 2.6 reward. Once TP1 is hit, immediately move your stop to entry, then trail with a 20-pip buffer to lock in gains. Invalidation. If a 4-hour candle closes back above 94.55, the breakdown has failed and you get out. The active trader, standard, entry, 93.80, 1H close below 93.87, stop loss, 94.30, take profit 1, 93.00, take profit 2, 92.10, risk, reward, 1 minute and 1.6 seconds, 1 minute and 2.6 seconds, invalidation. 4H close above 94.55, type your Brent range for tomorrow in the comments right now. Where do you see the high and the low? Let's see who is aligned with the institutional levels. Now, the aggressor. This is the high-risk, counter-trend play for traders who can lose small and manage risk aggressively. Despite the daily strong sell, the 93.87 support has held on multiple tests, and that hidden bullish divergence on the 4-hour is a real threat to anyone who is overly short. If we see a strong bullish engulfing candle on the 1-hour right at 93.87, accompanied by an RSI bounce from near-oversold territory, we can play the squeeze. The entry is a buy stop at 94.05, after a 1-hour candle closes above $94, confirming the rejection. Stop loss is tight at 93.40, just below the recent swing low and any stop hunting wick. Take profit 1 is $95, a rapid 95-pip move, giving a 1 to 2.3 risk reward. Take profit 2 is 96.13, the Monday high, if peace headlines suddenly reverse and the war premium snaps back. This trade fights the daily trend, so only size for a maximum 1% account loss. The setup is instantly void if a 1-hour candle closes below 93.87. The aggressor, high risk, entry, 94.05, 1H close above 94.00 after 93.87 test, stop loss, 93.40, take profit 1, 95.00, take profit 2, 96.13, risk, reward, 1 minute and 2.3 seconds, 1 minute and 5.3 seconds, invalidation. 1H close below 93.87. Listen carefully. Never risk more than 1 to 2% of your trading account on any single trade. Avoid holding positions through high-impact news like EIA inventory reports or unscheduled geopolitical headlines. Stops are non-negotiable. They are your survival tool. This discipline is what keeps you in the game long enough to catch the next explosive move. Let's lock in the single most critical level for the next session, 93.87. A daily close below that support flips the medium-term outlook decisively bearish and targets 92.10. A solid bounce from it, accompanied by a bullish MACD crossover on the 4-hour, would instead open a relief rally straight toward 96.13. Tomorrow's wildcard is the EIA crude inventory report, plus any tweet or statement from Iranian or Israeli officials. I will also be watching the S&P 500 correlation and the real-time bond market for risk on signals that could suddenly deflate the oil bid. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live right now. Tap the end screen. Smash like if this plan gave you a clear edge. Subscribe, hit the bell, and I will see you in the next one. This is Alpha Market Meridian. Stay ahead of the move.